Global Corporate and Specialty. I'm very happy to welcome you to the first Made in Africa digital event since launch of new AGCS in June last year. Thank you for your time and your attendance to this new regional event. Today, we host you AGCS top clients and brokers. Indeed, we are close to 200 people connected across all countries of the region, covering our 5 offices in Belgium, the Netherlands, Italy, South Africa, and France, but we operate also in Cyprus, Greece, Malta, and Morocco, where we provide excellent AGCS service and risk solutions. I would like to say a few words about our region, which is a very diverse one from Rotterdam to Milan through Johannesburg. Just to give you the flavor of our playground, AGCS Made in Africa region has 460 employees, 18 languages, different time zones, 127 underwriters, 43 engineers to perform surveys on site, almost 18,000 claims handled annually, more than 800 million euros of gross written premium in 2020, and above all, a strong market presence as a leading insurer in all sectors of industry through 8 lines of business: property, casualty, energy and construction, financial lines, marine, entertainment, aviation, and space. In short, we have a great team fully dedicated to deliver the best service every day, whatever the functions. Coming back to our topic of today. First, let me explain why we have chosen this topic. We all had an unexpected and unprecedented year 2020, and we are all aware that 2021 will be as challenging in numerous sectors of industry. The question is, how challenging will be the coming period? What trends should we anticipate for the next few months? This is why it's important to get updates from our Allianz experts. They will enable us to better understand the current economic situation and the main trends in terms of risk that the Allianz Risk Barometer has identified. Based on this, I have the pleasure to introduce today's speakers. First, Patrici Thiels, the Managing Director of AGCS Made in Africa region, will give you a short update about AGCS, and more specifically, what we call the new AGCS. Patrick will detail strategy and key principles. Then, we will welcome the head of macroeconomic research of Euler Hermes, Boata. Due to unforeseen circumstances, Allianz Chief Economist, Ludovic Subran, will regrettably not be able to join this session. We are nevertheless delighted to have Anna share her expert economic insights. She will give us a complete outlook of the global economic landscape. As always, this will be a very exciting and complete deep dive in the world economic situation. Next, we will hear from Andrew Lindsay, the head of marketing and sales support activities for Made in Africa region. He will introduce the 2021 Allianz Risk Barometer results, with giving you the new ranking and trends of our global survey. Thereafter, we will focus on 2 main trends identified through the Risk Barometer. Marco Vincenzi, Regional Head of Financial Lines, will give us an analysis on cyber risks, which is, not surprisingly, one of the main risks we face. The second trend we will deep dive in is the business interruption risk. Jean-Baptiste Régnier, Regional Head of Property Underwriting, will explain why this risk is more than ever the top risk in the current landscape. We will end the presentations with an opportunity for you to ask questions. This will be moderated by Olivia Smith, our Marketing and Communications Officer based in Johannesburg. Please kindly note that we will answer questions only at the end of the webinar and not while during the speakers are talking. However, you may, of course, post your questions any at time using the Q&A functions at the bottom right-hand side of your screen. I'm delighted now to introduce the AGCS Mediterranean Africa Managing Director, Patrick Thiels. Patrick joined Allianz 8 years ago. Prior to taking up a role as CEO in Belgium and Luxembourg in 2006, he was Managing Director of Gerling Concern in Belgium from 2001. He's a Belgian national with a 35-year career in insurance and management and has an extensive experience in leading and setting up new strategic business units and in managing operational companies across national boundaries. Patrick has been made Knight of the Order of Leopold in Belgium. Ladies and gentlemen, please welcome Patrick Thiels.
Many thanks, Marilyn, for that nice introduction, and also from my side, very warm welcome in those great days here in Brussels. I think in Johannesburg it's now the end of the summer, but here it's quite a great weather. So it's a pleasure also to host you today, and I'm very honored to talk to you as my first appearance again as Managing Director in this cultural, rich and diverse region, Mediterranean and Africa. The geographical locations of today's speakers reflect our diversity. I'm seated in Brussels, as you know. Marco is in Milano, Marilyn, Andrew, Jean-Baptiste, and all the technical staff in Paris. And Olivia, who is supporting us in the moderation later on, she's sitting in Johannesburg, as indicated by Marilyn before. Also, Marilyn pointed out we have 5 legal offices, and our group mandate is even broader because with all Africa, we are now covering 62 countries in the region where we can underwrite all the corporate lines, as mentioned before. So we are one of the 6 regions. We have now a new regional structure. We want to really make the real center of decision in the region so that we have we are moving more from a country-centric solution to more global setup with the regional empowerment so that we really are close to our markets and our clients who are having the same, let's say, structure in their global approaches. The principle is very clear. We want to be as close as possible at your entry door, that's in your local countries, but for your trading, for your insurance, for your underwriting, for your claims, for your risk engineering, we want to have the best specialists in the region at your disposal. So that's the combination that we want to bring. So as close as possible to the door for your day-to-day inquiries, and then giving the whole infrastructure of the region at your disposal to really support you in this journey. The region is an important one. We are already contributing nearly 10% of the revenues of the group. And here I would like to make some comments on the 2020 results of AGCS. Can you imagine a year ago that this situation with COVID would change our lives? Personally, but also professionally. We are now used to work on a virtual way. We don't see our friends anymore. We do not have lunches anymore with our beloved partners, so it's a little bit confusing for all of us and very complicated for people who are sometimes isolated. So pay attention also in your organizations to those people. I think it's important that we don't forget the human factor here. But also the industries were really, let's say, impacted enormously. Also our insurance industry. And we didn't, as AGCS, escape to that. It's already 3 years in a row that we are now negative. And let me share some key results from 2020. So the turnover is now 9.3 billion. We call that the gross written premium. But the combined ratio was now 115.5%. And that leads in 2020 to the worst result ever of a negative result of 482 million euro. So the combination, it's on one hand, COVID had a really big impact on our results. We are market leader in entertainment, for example, with cancellations of events, but also BI events, we were really hit quite heavily. But we see also deterioration in prior year claims, like especially liability. We have a lot of class actions. We have problems in the recall books, where we had in Germany and France major losses. And we had to we were required to strengthen our reserves and increase also. We see an increase of cyber ransom claims. Marco will tell you a little bit later about that, and catnet claims. So that is, in a nutshell, what was influencing our results in 2020. You can imagine that our shareholder was absolutely not satisfied, and he asked already last year to implement a drastic remediation plan. We call it the new AGCS. It's quite original, but I know that. But nevertheless, we want to work around a pure transformation program to return back to profitability in 2021. The major pillars were reducing the volatility in our books and in our portfolios, and optimize our cost effectiveness, so our internal processes. We have taken already a lot of corrective actions in underwriting. So we did lose some business. We addressed some underperforming segments. Give you some examples. So Hull in the US, for example, we closed that book. We are revising the recall portfolio, like I already mentioned. We closed our Dubai office because we had only a reinsurance license. It was very costly to have that with, let's say, in the reinsurance market where you can operate from other regions also. And we are now refocusing pure the business on the new AGCS strategy. I think for 2021, we will still have some impact on COVID-19 claims, but we have now strengthened our reserves, so the impact will be minimized. When I speak about the new AGCS strategy, we will, as a region, play also a very key role in this one. We launched that project in June 2020, and it's a large transformation program. We ensure to really, on one hand, to ensure the never-changing risk exposures from your side, and on the other hand, also to be best in class in our service delivery, and that at the low-cost possible. As you know, in our organization, a number of new leaderships were being appointed, even at board level, and also at global and regional levels, really to support this transformation. There are three major blocks on this strategy. First of all is the focus on core markets and segments. So we have revisited our lines of businesses, like I mentioned, by offering new solutions for the evolving risk landscape. We have a clear definition now of our risk appetite with our clients, but also in the light of our claim experiences to enable future profits again. And we are focusing on increasing responsiveness and reducing our complexity in our organization for really to work on a lower cost basis. The second block is the technical excellence. You know, we have technical people. We want to be a technical underwriting company. We want to understand your risks, but that feedback, and with our claims management, we want to bring that in the pricing tools so that for the risk transfer, you have the right price on our balance sheet. And last but not least is global first. We want to simplify the structures. We want to be a global player, meaning that all you as a client, you as a broker, you will see the same AGCS across the world with the same processes behind, so that we really can be very cost effective in this area. We created also a new unit that's called New Global Distribution, and I was quite one of the pioneers in this respect, because it was my previous job to set up this new function, so that we are also able on distribution to serve our clients and brokers in a similar way with the same approach, but also with focus on data, so that we can improve our organization also here. And one of the topics that we have realized is a so-called holistic view on certain industries. And we call it the Specialized Industry Solution Director, ISD. We have now for three industries this solution in place. It's about financial institutions, it's about telecom technology and media, and construction is nearly finalized. So we try to offer that in the next months. What is this about? It's about finding solutions for clients, and not only with the lines of businesses from AGCS, what AGCS is underwriting, but also looking abroad in the Allianz organization, where we have our sister companies like Euler Hermes, Allianz Partners, Allianz Global Investors, even the local Allianz entities, to work together to serve our clients in a more holistic view and to find solutions for them. What is remaining unchanged is the full attention and focus on your feedback. You know, we are organizing NPS, and I really thank you for participating on this one. We're also conducting the risk barometer. That gives us a very good feedback, what's happening in the market, what's keeping you awake at night, on the other hand, so that we can really engage with the teams to bring you and be the best in class in the services and in the offering. Where we should pay attention is in these complicated times where you see re-underwriting in the books, that we have a much better communication. So we will force the people who are in front of you to really to start in an early stage to look to your risks and to find the solutions so that we can avoid the best, let's say, the mauvais surprise, like we say in French. Claims and risk consulting, we want to state as state of the art. We have seen in the NPS that we have a quite good feedback on this one, so we want to keep that as a really a service up as state of the art, and also to improve our operational services. We see that we had some issues in our global network. We also want to work with our global partners and our colleague network partners from Allianz to improve there also the services. Besides that, I still can still confirm that we are AA rated company, Standard & Poor's, and that we are fully empowered now in the region to really to serve you in the best conditions for all lines of businesses, of course. And personally, on behalf of my team, and I would like to thank you for the trust in our company, but the trust also in the people who are in front of you. And now I have the pleasure to introduce you to Anna Boata. Anna is Head of Macroeconomic Research at Euler Hermes since October 2019. Alumna of Paris 1, Panthéon Sorbonne, and Paris 2, Panthéon Assas. After 2 years as an economist at Exane BNP Paribas, she joined Euler Hermes at November 2012, and this as an economist specialized in European markets. In 2018, she was being appointed head of the European Research and SME thematic research and became head of macroeconomic research in October 2019. Anna received the 2019 Best Forecaster Award for the Eurozone. This was given by Consensus Forecast. She gives regular interviews covering current questions on Brexit, Italy or Greece to major international media such as BFM, Le Monde, Les Echos, CNBC, Channel 4, The Times, and Milano Finanza. In parallel, Ms. Boata teaches macroeconomic courses at Dauphine, as well as country risk classes at Sciences Po Paris. Anna, I'm happy to give you the floor.
Thank you, Patrick. Thank you for this nice introduction. And I'm very pleased to be by your side today to give you our view of 2021, but also 2022. It's all about vaccine and vaccine economics. And if we go to the next slide, I just wanted to show you where do we stand globally in terms of vaccination, because this is the key to the exit from the sanitary crisis. This is clearly the key for having a more sustainable and strong catch-up effects in 2021, but also 2022. And on the chart on the left, actually, you see that we have a quite divergent and heterogeneous landscape at the global scale. We have the United States and the United Kingdom, which are much faster in vaccinating than Europe or the emerging markets. So those two countries are likely to reach herd immunity, so 70% of the adult population vaccinated in May, which means that we can expect from them quite already strong rebounds starting in Q2 2021. And on the other side, we have Europe, where we struggle because of some supply issues, but also some distribution and demand issues. And obviously, if we don't speed up the vaccination, you see here the expected date for a herd immunity, which is later on in fall, October, even November, or even 2022 for some countries. So currently, we are 7 weeks in delay regarding the European Commission target in Europe, which is to vaccinate 70% of the adult population by the end of summer. So clearly, we now need to speed up the vaccination for vulnerable people, but also for the whole adult population by 8 times. So this actually seems unrealistic. If it would have been realistic 1 month ago, now we have accumulated even more delays. So I think it's more realistic to expect a wider reopening of the European economies late summer, start of fall. Of course, why do we care about that? It's also because of the longer delays which feed up into economic costs. The longer we stay into this light lockdowns, curfews, the higher the economic losses. And you see on the chart on the right that actually the time that we are, like the 7 weeks of delay, are equivalent to more than 100 billion euro of economic losses in the European Union. So that's actually twice the amount of the European Recovery Fund that has been negotiated at the European scale. And this is clearly something that would have negative repercussions in the end if we can't manage to speed up the vaccination. In the emerging markets, the situation is even worse because they didn't plan to vaccinate more than 20% of the adult population through the COVAX facility. So clearly, we will be in a multi-speed recovery environment. And if we go on the next slide, I wanted to clearly show you a bit where we stand in terms of economic activity, because we have learned from the first confinements that we can't close the whole economy. We have taken a much more targeted approach where we have implemented lockdowns in those COVID-19 sectors, those super spreader places, hotels and restaurants, leisure, non-essential retail in some countries. So clearly here, if we look at the share of these sectors into the whole economy, we talk about 15 to 20% of the economy. So that's quite a lot because these sectors are not operating at full capacity and they will take time before they come back to normal levels of activity. And clearly you see also in terms of confidence on the chart on your right that we do have a divergence between manufacturing and services, but also construction. Manufacturing and construction are sectors that continue to recover since the first lockdown, and obviously services which are now in contraction and in recession because of the lockdowns. And this is clearly more or less the view across the world. And now if we look also on the next slide in terms of trade, because we clearly have a services crisis, yeah? So we do need to look what happens in terms of global trade and especially in global trade of goods. You see here that indeed the recovery has been what we can call almost a V-shape in terms of trading goods. Of course, it has been much more easier to continue the activity in the manufacturing and construction sectors, and this drove also global trading goods back to pre-crisis levels already end of 2020. But actually you see that this recovery has been mainly driven by China. China has taken the opportunity to actually increase its global market share during this pandemic because of its positioning in the global supply chains, because of the fact that they were replying very well to the current needs in terms of medical equipment, but also in terms of housing, construction cycle, and the residential construction cycle. So clearly that's something that has brought them to a record high market share. But what we have observed already since Q4 2020 is that we start to have some bottlenecks in terms of global trading goods. The supplier delivery times have deteriorated very fast in Europe, but also in the United States. And you see here in the chart on the right that the lowest we are, the worse it is. If we take the case of some sectors like electronics, for example, semiconductors, we are now several months of delays in terms of deliveries. So obviously this will have an impact going forward in the speed of the recovery in global trade of goods. And it has already an impact in terms of prices. And if we go on the next slide, you will see how fast input prices are increasing for companies in the manufacturing sector in Europe, but also in the US. And you see here actually the difference between the dotted lines and not dotted lines is actually the pricing power of the companies in these sectors. And we see that there is very little pricing power. Rising commodity prices, rising transportation costs, bottlenecks in terms of containers and imports from China, and the fact that companies are trying to rebuild inventories, and especially in Europe, where we are a bit later in this process compared to the United States or Asia, we clearly see that there is an impact in terms of margins for companies. There is little pricing power, so there is little rise of selling prices in terms of input prices. So that's something that is a bit worrying in terms of impact on companies' margins. Companies' margins which already lost quite a lot in 2020, in some countries more than others, despite the unprecedented fiscal and monetary support. And that's obviously something that will have an impact in terms of the strength of the investment cycle going forward. Now, if we go to the next slide, I also wanted to talk a bit about the fiscal stimulus, because this is what's driving today this artificially low environment of credit risk, of insolvencies, but also this is what gives us resilience in this pandemic. And of course, here we also have heterogeneity among regions of the world and countries. The United States just announced $1.9 trillion of fiscal stimulus, a huge amount of stimulus. China, on the other side, has announced that they will stimulate a bit less the economy in 2021. So they will do around 4% of GDP, whereas they were doing more than 7% last year, but they still do quite a lot. And on the other side, Europe, which is struggling to implement the European Recovery Fund because of its bureaucratic aspect and because of the fact that we can't actually agree on being more agile in implementing this fiscal stimulus. We certainly had a lot of fiscal support, but we did not have yet fiscal stimulus per se. So of course, this also will have a significant impact at the end and at the turn of the crisis, because we need to go from fiscal support, which is partial unemployment schemes, tax deferrals, subsidies, everything that is helping today to support the losses in terms of turnover for companies or profitability, into fiscal stimulus, which is supporting the purchasing power still, or trying to support the future demand, but also trying to support the investment cycle through, for example, hyper-amortization schemes or tax breaks. So that's something that for now, it's quite uncertain, this pass-through from fiscal support to fiscal stimulus, a manageable pass-through, because what everybody fears is the fact that we are now in an unprecedented state interference in terms of economic activity. And we do know that with time, and as long as we stay into this environment, the economic activity is disrupted and could be disrupted if there are policy mistakes. So of course, we do still have a lot of liquidity in the world because all the central banks are still in a very accommodative stance. They are likely to remain so at least until 2022, if we talk about the United States, which will probably be the first one to tighten. But we do see that there is a lack of full transmission of this liquidity to the private sector. What is also a risk going out of the crisis is that because of the absorption power of the state support, we do see that some of the companies have been protected. They have more cash, but on the other side, when the state support will not be there anymore, they might be tempted to increase prices because they know there are some excess savings out there and because they need to rebuild their turnovers, their profitabilities. So we might see a temporary overshoot of inflation across the world. In some cases, it will be driven by commodity and food prices, like the emerging markets, and currency depreciations. And in other cases, it will be just driven by the catch-up effect, pent-up demand and base effect, like in the advanced economies. Now, if we go to the next slide, I also wanted to drive your attention in terms of this multi-speed recovery. We are clearly in an environment where in 2021, the US is driving 1/3 of the global recovery. So that's great because that means more than $360 billion of additional exports for the world. But on the other side, we do know that they are stimulating quite a lot the economy, a bit like Obama did back then. And we could see negative financial repercussions starting in 2022, similar to what we have seen in 2013 when the taper tantrum started and some of the emerging markets have suffered quite strong currency depreciation. And we could have a bit the same volatility. We do see that China is back to pre-crisis. Therefore, the US also, thanks to the stimulus, will be back to pre-crisis that was already mid of 2021. But what happens with Europe and the emerging markets? It seems like we are a bit caught in the middle because we don't manage to speed up the vaccination campaigns and get out of the sanitary crisis. We don't manage to implement fast and strong fiscal stimulus. Also in the emerging markets, quite a lot of limited fiscal space after what has been done in 2020. So of course, there is also the question of this heterogeneity between regions. And in Europe, to give you an example in terms of pre-crisis levels, most of the countries are not expected to go back to those levels before mid of 2022. And of course, that's dependent on the vaccination speed. So we could even see a more delayed recovery than what you see on the chart. And now I think it's time to go a bit deeper in terms of country outlooks and the countries of our webinar. And I will first start with France. If we can go on the next slides, please. So in France, the good news is that, of course, we have a lot of excess savings. But you see on the chart that it's not only about France. It's obviously about European countries where the governments have intervened massively in order to support the companies and in order to avoid an insolvency wave and in order to support jobs. But of course, the question today is what happens with this excess savings? Because we see that the money is not circulating in the real economy. This money is currently blocked on bank accounts, money from companies, but also from the households. So everything is dependent on the confidence effect and how strong the government would be able to reassure people that we will be exiting the sanitary crisis on a sustainable way, but also how strong the government would reassure households that there will be no strong increases in unemployment rates, for example. But we do talk about huge amounts of excess savings. If we look at the household side in France, we are at close to 3% of GDP. And if we look at the company side, the yellow bar in the right-hand chart, we do talk about 7% of GDP. So we do see that there are a lot of upside risks in terms of the recovery in France. And on the next slide, you'll see that obviously this pent-up demand will drive growth in 2021. So we do expect 5.4% growth in 2021. That's much more than the Eurozone average, which is at 4.3%. And you see that the main driver to this recovery will be investment growth. And the good news is that because we have this divergence among sectors, you see on the chart on the left that the industry is almost back to pre-crisis levels, as well as construction. We do see that there is an investment cycle which already started in France. And on the other side, consumer spending. If we think about summer 2020, the reopening has created a lot of euphoria and consumer spending in France. And we do expect consumers, regarding also the excess savings that they have, to continue to spend in 2021 as a catch-up effect. And back in 2022, we do have a slowdown to 3.6%, but this still remains the double of the potential growth that we can see in France. So of course, this is again dependent on the vaccination campaign, but I think we can be relatively optimistic that the recovery would be quite strong, also because we have been in a very strong recession in 2020. So again, the catch-up effects are very strong. Now, if we move to Benelux, I think the situation is a bit more mixed because we do see in terms of retail sales and consumers that there was a very strong cautiousness from their side. Retail sales have contracted quite fast during Q4 2020 and also at the start of 2021, the situation is not looking great. But also we understand why. If we look at the unemployment expectations, these are at the highest level since the great financial crisis back in 2009. And we do see that the higher the uncertainties and worries about unemployment, the higher the savings intentions. So we do understand that it might take a bit more time before this excess savings would be unleashed also in these countries. And also it's a bit the same situation when we look at the external sector. Order books on the next slide are still below normal levels. There is still a lot of pessimism from the Belgian or Dutch exporters. And we do see that capacity utilization rates in the manufacturing sector remain below long-term average. But we do expect the investment cycle also to kick in these countries, again, because of the massive support of the state in terms of 2020, in terms of direct subsidies, tax deferrals, and partial unemployment schemes. Just for you to know, we have the impression that France did quite a lot. And yes, France did quite a lot, but they did a lot in terms of state-guaranteed loans. But if we look at Belgium and Netherlands, actually the governments have spent much more in terms of direct fiscal support and less in terms of additional debt to companies. So indeed, if we think about that and the excess savings also that the companies in these countries have, we should expect an investment cycle to kick in later on this year. So I think it's more about H2 2021 at this point, because these countries are even later in terms of vaccination than the European average. But the fundamentals are there in order to see much more investments going forward. And of course, these countries are also set up to benefit much more than others in terms of Biden plan and in terms of additional demand for exporters from the United States. If we now move to Italy, I think it's also important to take a look at what could drive growth in Italy. Of course, the sanitary situation is a bit worse than in other European countries, and they struggle to stabilize the new infections despite the quite long and strict lockdown that we had since November. But I think there is also a huge potential here because Italy is one of the main beneficiaries of the recovery fund at the European scale. So we talk about more than 5% of GDP over 3 years, but also 1/3 of that is expected to be disbursed in 2021. Of course, Italy is also about political risk, about public debt and market confidence. But currently, with the change in the government and the comeback of Draghi, of course, we do expect that to remain in check during the course of 2021 and even 2022. The good news is that elections are not planned before 2023, so Italy should benefit from, let's say, calm waters going forward. And before we end the presentation, I briefly on South Africa. South Africa, it's a bit at the crossroad in terms of financial strength, but also economic cycle. I just want to draw your attention about what I was explaining, taper tantrum and the Fed start of normalization of its monetary policy in 2022. Unfortunately, South Africa is one of the main fragile emerging markets to this operation from the Fed. If you look at the indicators that are showing if a country is vulnerable or not, of course, current account balance is less in deficit than it was back in 2013. But we do see that there is a strong increase in external debt, but also in the debt that is held by non-residents. So, of course, that's a very fragile situation, and that's a strong vulnerability to capital outflows and to the fact that rates will increase in the United States. And with that, the capital will go massively back in the US, and South Africa, in this case, would be impacted and could see quite strong impacts in terms of currency depreciation. The good news is that South Africa still has market access, but with these fragilities in place, we might see some debt sustainability issues. And if we talk about the economic cycle, if we go on the next slide, I think what's striking is the fact that there has been little reform momentum in South Africa. And also the cycle is very bad with the epidemic, which is with the new variant, with the lack of vaccination, but also with the unemployment, which has quite significantly risen in 2020. We are now at more than 32%. So of course, seeing a potential for a strong rebound of the private sector seems very limited. And this is why when you look at our forecast in the table, you can see that South Africa is expected to grow by 1.9, 2.1 in 2020, much below the African average. So we do see growing downside risks in South Africa. And obviously, we will need to monitor that very closely just to understand how South Africa would be able to exit and also to manage the vulnerabilities that we expect in 2022, again, because of the taper tantrum and the reduction of the balance sheet of the Fed. And obviously, that is a major risk in our view for South Africa. So I'm at the end of the presentation. I will be happy to take questions at the end.
I'm Lindsay. I'm the marketing and sales support manager for the Mediterranean and Africa region of AGCS. Very happy to be with you, and what I'll be doing for approximately the next 10 minutes is sharing with you some of the highlights of the 2021 Allianz Risk Barometer report, which we published just a couple weeks ago. Now, for those that are not familiar with the Allianz Risk Barometer report, yeah, that's it, perfect, we have the next slide. I'll just provide you with a little bit of context. So the Allianz Risk Barometer report is an annual survey that's carried out by AGCS. And basically, in that survey, we asked respondents to first tell us which industry they are most knowledgeable about, and then based on that, we asked them to name the top 3 risks for that industry that they have selected, that they believe to be the most important ones for that industry. So the last edition that we had was the 10th edition of the survey. So we've ran a survey for the last 10 years now. It was also the biggest one that we've had with, as you can see, almost 3,000 respondents coming from 92 different countries and territories. The respondents themselves are mostly Allianz customers, but also brokers that we work with. We also have some Allianz and AGCS employees, be it risk consultants, underwriters, and claims experts that take part in the survey. Generally speaking, the answers that we got from the last survey allowed us to cover 22 different industries, and about half of the respondents were working for companies that have what would be considered as large-sized companies with a turnover of $500 million or above, whereas the other half, the smaller half, let's say, was or is working for mid-sized or small-sized companies. So that's for the background. If we move on to the next slide, which is probably the one key slide from the Allianz Risk Barometer, what you see on the screen here is the list of the top 10 global business risks for 2021, as per the responses that we got from all participants in the survey. Now, just for clarification purposes, before we go into the details, when a risk here is marked as red, that means the risk is ranking higher than in the prior edition of the survey. Whereas if a risk is marked as green, that means the risk is actually lower in the ranking than it was in the previous edition of the survey. Now, if we look at the top 10, I mean, we'll be interested in going into a little bit more detail of the top risks. But before we do that, I just wanted to run you through the top 10 in reverse order. So I'll start from the bottom right very quickly, just to give you a sense of what are the risks that are outside of the top 3. So number 10 is the political risks and violence. That's actually a risk that has taken over terrorism as the main political risk identified by companies globally. And it's also one which we may see climb in the rankings in the future, because it's expected that we'll see an increase in both protests and riots between now and the end of 2022. Number 9 in the ranking is climate change. As you may know, 2020 was the hottest year on record, jointly with 2016. So as opposed to some other risks, like the pandemic, which we'll be talking about later, which was very sudden, climate change is a risk that unfolds basically in slow motion, but remains a high concern for businesses across the globe. Number 8 on the list is the macroeconomic developments. I won't go into those details because I think Anna did a really good coverage of this in the first part of her presentation. So if we move to number 7 in the ranking, it's the fire and explosion risk. Probably more a traditional risk in a sense, one that we've known for a while, but still perceived as having high impact, and one where mitigation practices that companies implement are still key to reduce or mitigate as much as possible the risk associated with fire and explosion. Risk number 6 is natural catastrophes. Again, because the pandemic dominated the headlines in the last 12 months, we may have talked a little bit less about natural catastrophes. But you might remember at the very start of 2020 the Australia wildfires. You might also remember the California wildfires. So those are just 2 examples of natural catastrophes that occurred in the last 12 to 15 months. Many more as well. So still a high concern for companies because it's something that can have a high impact on them. If we move to the left part of the slide, the changes in legislation and regulation is in the top 5, ranking number 5. A very dynamic environment, and I think an example of that, of a topic that's a big topic in Europe, is the data topic. For example, there's a lot of discussions around regulations related to data, data access, data usage. You also see a number of examples here on the slide that just shows the many areas that are very dynamic and therefore potentially seen as a risk for global businesses. Number 4, market developments. Same here. I think Anna gave us an overview of market developments in the different countries of the Mediterranean and Africa region, so I won't go into the details of this one. But let's talk about the top 3. So number 3 is cyber incidents. So as you see from the ranking and the green that is associated with cyber incidents, cyber is actually has lost the top position in the Allianz Risk Barometer ranking. However, what we have seen is that cyber was mentioned by respondents as the top risk or more frequently than in the prior year. So no longer the top risk as per our ranking, but viewed very much as a top risk by more respondents than in the prior year. So still a risk that we see as rising in importance. Number 2, probably no surprise here, but it's the big change in the Allianz Risk Barometer report. It's the appearance of the pandemic risk in the top 10. So as you see, in the prior year, in 2020, the pandemic was ranked number 17. So it's obviously the highest climb that we have in the ranking. It's the first time that this risk is in the top 10. I think the highest rank for that risk in the last 10 years has been number 16. So I think it just highlights the fact that we all knew that a pandemic theoretically was the risk. But we actually needed it to happen to us, unfortunately, to really understand what massive the impact can be related to that risk. But yeah, the big change for the top 10 is the pandemic at number 2. And then at number 1, it's the business interruption risk. It's a return to the top of the ranking for business interruption, or BI, as we call it. Indeed, business interruption has been ranked as the number 1 risk in the Allianz Risk Barometer report for 8 of the 10 editions that we've had. So it's been constantly over the years being viewed as a key risk. Now, if we move on to the next slide, and because this event is bringing together partners from both the Europe region and the Africa region, I just wanted to take a moment to show you what the rankings look like in each of the respective regions. So looking at the respondents from those regions, you see on the left what is the ranking of the top risk for Europe. And on the right side, you see what those rankings are for Africa and Middle East. And what you see is that basically the top three is the same as for the global list of top risks, with, again, cyber, the pandemic, and business interruptions dominating the top of the list. So if we move to the next slide, Lydia, thanks. So talked about the top three risks in 2021 as identified in the Allianz risk parameter. At AGCS, we call them the COVID trio. And the reason why we call it the COVID trio is that those three risks are actually really closely interlinked, which obviously makes a lot of sense given that we're in a world that's more and more globalized, and also a world that's more and more connected. So three risks that are very, very tied. And if you think about it, and if you try and look at it very simply, think about how we had the pandemic start towards the beginning of 2020, which led to lockdowns in many countries across the globe. I would say most countries across the globe, probably. The lockdowns had at least two effects, but two effects that interest us in the context of this trio. One effect is that many businesses shut down and impacted the supply chains of many businesses around the globe. So there you immediately can see the link between the pandemic and the business interruption risk. And then what the lockdowns also meant is that a lot of us had to move to a remote working situation. A lot of us are still in a remote working situation. And that meant an increased reliance on digitalization and technology. And there you can see the link to the cyber risk. So basically, we knew about BI and cyber as important risks that global businesses need to face. The pandemic has only highlighted those risks and shown how those risks evolve over time. Olivia, if we move on to the next and my last slide, what we will be doing now, we'll go into a little bit more detail around those two risks that I was mentioning, the cyber incidents and the business interruption. So Jean-Baptiste Régnier, our regional head of the property, will talk about the business interruption risk. But first, we'll have Marco Vincenzi, who's our regional head of financial lines, and he will talk about cyber risk. So Marco, over to you.
Thank you very much, and good morning also from my Italian side. It's a big pleasure for me to take over. This is a lot about cyber. However, it looks like to me also a big challenge too. In fact, you could easily wonder what Marco can say in roughly 10 minutes about cyber risk that we already don't know. So the answer, unfortunately, could be also quite easy. Maybe nothing. We'll see. So I would like to base my speech on my experience of financial lines, and I will try to focus on three key messages. So the first one is why cyber is at the top of the ranking. The second main topic will be why cyber insurance matters with respect to ransomware. And finally, I will speak about cyber, which matters with respect to D&O insurance. So if we start from the Allianz Risk Barometer analysis and we speak about cyber at the podium of the top risks, we have seen that this is number 3 globally in the ranking, but it is number 1 in Europe, is number 1 in South Africa, and is number 3 again in the African continent. Another thing to think about is that it is number 1 in some sectors which are very close to our daily business, like financial institutions, like utilities, like professional services, and also including IT solutions. The reason why cyber is at the top of the rank is driven by several factors. Of course, we are experiencing already claims, issues, but there are other reasons why cyber is at the top. So, for example, the shift to remote working. It's a matter of fact that companies are more exposed than the past. So even if we have seen the industry sector demonstrating its ability to change mindset, to allow people working from home, on the other hand, other issues have come up. One of the issues is information security, which is becoming area for major investments. Rapid adoption of cloud, for example, is absorbing more than 40% of the IT budget investment. And this is also doubling within the companies the efforts in monitoring, in governance, in compliance issues. So this is why, even if we are still observing mainly business interruption claims related to cyber, data breach and IT vulnerability, as you can see in the chart on the right side of the slide, is what is keeping IT managers awake at night, more than business interruption. So if we speak about IT vulnerability, and we can jump into the next slide, this is easily leading me to touch base with the biggest issue of nowadays that we are observing, ransomware, which is strongly related to IT vulnerability. Attacks are becoming more and more frequent and more sophisticated. So we have to think about and focus on the role of insurance and the insurer in order to protect clients from ransomware attack. The insurance market must be sustainable if we want to provide with solution to our clients. Unfortunately, as a legacy of the past, sometimes the insurance policies are simply seen as a source for reimbursement when I have an issue. That's a wrong approach. That's not the right approach. The insurance market must become disruptive for the ransomware business. How to do that? We have to work together with the clients and the clients with the insurers in order to set up some key points in order to protect business, the end insurance business. For example, we have to update and adapt our skills for prevention. We must have a deeper understanding of the entire supply chain in each and every step. We have to train, we have to inform, we have to get access and give access to data, and without forgetting the quality of the data. And lastly, we have also to create enough layers of securities. This is a joint journey that must be done by client and insurance market in order to both sustainable on both ends. So the question is, who is the person who has to start this virtuous journey in order to set up the layers of security? Who have to put in place the first decision? Definitely the board of directors. So we have to think about another angles of the cyber issues. The cyber is attacking the boardroom. I have dedicated one slide about D&O insurance and the correlation with cyber. Breaches experienced and cyber-related issues have, in the most of the cases, caused share price drops. In the next slide, you can see how the cyber can attack the boardroom and what kind of consequence can happen into the D&O insurance program. The financial investors are looking more and more at the risk management procedures about cyber securities, which means that the board of directors becomes the key body for controlling and supervising, but not only. The board of directors becomes the key body for budget allocation and IT investment allowance. Of course, we immediately see the other side of the coin. If the board must make such decisions, in the same time, the board can be identified as potentially liable for the cyber-related issues that the companies can experience. Think about fines, think about business interruption again, think about the reputational risks on the market, think about the corporate disclosure if you are a publicly listed company. So you have to give information to the regulator, you have to give information in the documents that you have to file, for example, if you are listed at the New York Stock Exchange, and then with the risk of a potential class action. So you can see that there is a strong link between cyber exposure and D&O exposure. And of course, there is a strong direct consequence on the D&O programs, and unfortunately, as we have been already seeing, on the D&O claims. So what does it mean for the insurers? It means that there is a need of underwriting of the cyber risk when underwriting D&O insurance. But if the insurers need to underwrite that kind of exposure, also the clients need to give the right quality of the information and must be open to accept this kind of joint assessment. Coming into a conclusion of my 10 minutes speech, I would like to leave you with a couple of main messages from my side. So the first one is quite easy. Cyber matters everywhere and from various angles. And the second message is there is a need of a joint journey to make this market sustainable and the client ultimately well protected. Because as insurers, we sell promises, but we have to pay claim. So we also must make sure that our client are quite well protected. So transparency on both parties is the key step, is mandatory by definition, but also full awareness of the context of the scenario and full awareness of the scope of coverage. What we write into the policy must be well known, 100%, is a clear message that we have to keep for us and stress in our daily business. So on my side, thank you very much for your attention. I've been quite short, in less than 10 minutes, and I would like to hand over to Jean-Baptiste Régnier to speak about business interruption. Thank you very much again from my side.
Thank you, Marco, and morning, everyone. And I'm happy to take over. I'm Jean-Baptiste Régnier. I'm the regional head of property within the Mediterranean region. So, BI, business interruption. If we can move to the first slide. BI, business interruption, is highlighted again as a top concern in our survey. This is not new, but COVID-19 has reinforced the BI awareness with all our clients in multiple areas of the world, in multiple sectors. Pandemic has also stressed our client supply chain, like Anna was saying previously, and emphasizes new risks within our BI landscape. For instance, the economic consequences of the pandemic could fuel further political and social unrest in 2021 and beyond, with potential implications for supply chain and BI. Rising insolvency rates could also affect supply chain. According to Euler Hermes from a July report, the rebound of insolvency will start in 2021 on the second half. The pandemic has also added to the already growing awareness of BI exposures triggered by non-physical damage, such as cyber, blackouts, political risk, disruption caused by third-party suppliers, and in parallel, we can see on the next slide that traditional business interruption risk still need to be managed. CatNat, extreme weather, fire, explosion remain the main causes of business interruption for many industries and are the biggest threats for manufacturing and industrial plant and equipment. The cost of BI claims following fire and extreme weather has been increasingly with a trend towards high value and more concentrated supply chain. So to address this, risk management remains key. Risk manager is definitely a profession to animate the trio, and not the COVID trio, the trio: risk management, business continuity plans, resilience, and vice versa. And don't forget, resilience is also good for insurance. According to Allianz Risk Barometer respondents, the graph on the right side, improving business continuity management and business plans is the main action companies are taking now in order to de-risk their supply chain and to make them more resilient. So this is obviously followed by developing alternative multiple suppliers, investing in digital supply chains, more supplier selection, auditing, risk assessment, stock management. The coronavirus has added pressure to rethink the complex supply chain, which is by definition in the recent decades were becoming increasingly global and complex. We are seeing clients making change in their supply chain, including nearshoring, bringing the production to a nearby country, some reshoring, and challenging the location of the supplier. According to a survey from a European risk manager, 46% expect this year and the year to come to make changes in the supply chain following the pandemic. So de-risking supply chains to achieve operational resilience. COVID-19 has also highlighted how the most agile companies and the ones that were the quickest to react to pandemic were actually the companies that had an adaptive and an embedded risk management approach. Identifying and understanding potential black swan events will be challenging by definition, I would say, but the key to survival will be the ability for business to respond quickly. As companies now are preparing their future extreme BI events, they will need to consider a broader range of scenarios and triggers than they do today. So our pre-conclusion to that part is very clear. Meeting the challenge of business interruption requires first risk management before risk transfer. Talking more into details about insurability and BI insurance capacity. Again, insurance will be there, even if the BI capacity has decreased globally and is more expensive than before. But the pandemic definitely has shown that there is still a lot of work to do and to be done with regard to exposure qualification and exposure quantification. Analyzing risk would require risk professionals, clients, brokers, risk managers, consulting firms, to find ways of quantifying the exposure, including, of course, the new ones like the non-damage business interruption. With data, with analytics, with model, with predictive approach, and so on, and then consider what is insurable or not. The insurance industry cannot take away all the challenges of the BI, but we can work in partnership with client brokers as we do. We are able to underwrite the biggest driver of business interruption. Again, CatNat, fire, cyber, you have seen that with Marco. We offer risk engineering services to address this. We offer alternative risk transfer solutions to support our clients in this challenging time. As a conclusion, overall, 3 items. Risk management first, before risk transfer. Risk manager is a profession to ensure the company resilience. Resilience is definitely good for you, but it's also good for insurance. Thank you. I would welcome any question in the Q&A session.
Okay, Olivia, can you moderate a little bit the questions that we received?
Apologies, it's the mute button. Ladies and gentlemen, thank you so much, Jean-Baptiste, and all of our speakers. We are now entering into our Q&A session. My name is Olivia, and I welcome you to submit any questions that you would like for our choice, for presenter of your choice. If you would kindly hover over your screen, and there you will find the Q&A button. If you're using a mobile device, there will be 3 dots, a little menu, so in there you will find the Q&A session, the Q&A button.